Hi, Joshua Schlinsky, and thanks for joining me today for our 5-minute lesson on life insurance. Now, let's suppose you have a life insurance policy with $500,000 death benefit. There's actually a minimum that you can pay for that $500,000 death benefit, and there's also a maximum that you can pay for that death benefit. So my question to you is, who determines the minimum? People often take a moment to think about it, but most people come up with the right answer, saying, well, the insurance company determines that. Well, of course they do. They're giving you a benefit, so they determine the minimum amount of money you need to provide to them. But there's also a maximum that you can pay for this $500,000 death benefit. So who determines the maximum that you can pay for this benefit? A lot of people say to me, well, the insurance company. No, or they'll say, well, maybe it's me. No, but many people come to the conclusion, well, maybe it's the government. And they're right, it is the government. Specifically, it's the IRS. So my question is, why does the IRS care how much money you put into a life insurance policy? And the reason is because the cash value that grows inside of a permanent life insurance policy grows tax deferred and can come out tax free. So the IRS creates some guidelines for that. Now, the traditional way most people have been taught to provide permanent life insurance is to simply have the minimum amount going into the policy, which creates a smaller amount of cash value. But what we want to do for our clients is put in more money than the life insurance company asks for, up to what we call the IRS guidelines. And by doing that, we're keeping down the expenses. And by keeping down the expenses, what happens to your cash value? That's right, because there's less expenses, you get greater cash value growth. So what we're doing in a policy like this is we're creating a living benefits policy. We want you to take advantage of the IRS guidelines to be able to create the highest tax advantages of your cash value. A lot of people know what a Roth IRA is. It's after-tax money going into an account that would be hopefully growing if it's in the market, and when it all comes out, it's tax-free. That's the same concept by the Code of 72 and 7702 of a permanent life insurance policy. So here, by keeping down the expenses, you increase your cash value. So you get cash value tax deferred growth. You're able to also access that money, that cash value, tax-free. And on top of that, there are several additional living benefits. For instance, if you have an IRA, you can't take that money out before age 15 and a half without some type of penalty. That doesn't apply here. So you have liquidity, use, and control of your money. And I can't begin to tell you just how important that is. And by the way, for those of you who have met with me, know me, or read my book, or will meet me in the future, you're going to learn my personal story, just how important that liquidity, use, and control was to me in my 40s. I can't overemphasize that. Now, another thing that people have learned about this is the leveraged loan that you can create with a policy like this. Because what you're getting when you borrow the money out, the insurance company is going to charge you an interest on that, but they're also going to pay you their dividends and or interest on the full amount of money, even the amount of money you've borrowed out. So you're able to use this as your personal banking system. Some of the other living benefits are transaction privacy. Now look what's happened with Equifax, TransUnion, or just credit reports of any nature, or the banks. Every transaction you make with the life insurance companies are completely private between you and the insurance company. It's not being reported anywhere else. It's very safe, and in today's world, that's becoming more and more important. In several states around the country, I live in Florida, and it is in Florida, you have absolute protection from litigation. I have an awful lot of clients who are physicians, and litigation has always been important to them. I have a lot of clients who are business people, and we live in a litigious world, and litigation proof is something that's very important to many of the people that I've met. And this also works as a foundation to our overall financial plan, because I cannot express how important it is to have a foundation to our overall financial plan. If we have a foundation of safety and security, then we're able to build from there with other types of assets, knowing that we have this liquidity, this safe growth, cash value, and tax advantages. So it actually, in the big picture, increases your other assets' rate of return because you have a more comprehensive picture. And of course, at the end of the day, it is life insurance. So your cash value blossoms into a bigger tax-free benefit for your family. But to have this tax-advantaged vehicle with multi-purposes, I mean, think about it for a moment. You have one of these, don't you? Smartphone, iPhone, Samsung, whichever one. Is it really just a phone? No, it's your calendar, it's your clock, it's your email, it's the internet, it's your text, it's your photos, it's your video. It's a multi-purpose vehicle. And properly structured, overfunded life insurance can help you to compound your wealth as a multi-purpose financial vehicle. And even though I might have taken 7 minutes, that's our 5-minute lesson on life insurance. Thanks for joining me.